What's up everybody, Gen X Dividend Investor here. In this video I'll tell you the pros and cons of lump sum investing versus dollar cost average investing, using multiple studies that analyze both strategies in different types of markets. So if you value free content like this, then please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. The impetus for doing this video came from the following question I got from a subscriber named Nort who said, "Hello Gen X, I hope you're doing well. I would like to have your opinion. I have $50K to invest in my dividend portfolio. My question is, should I continue to dollar cost average, or should I lump sum invest into stocks like AbbVie, J&J, and Procter & Gamble? Thanks Nort, I'm doing well and I'm actually headed to Disneyland and then to Europe for a family vacation, so I'll be off social media and won't be posting another video for a few weeks, though I'll still be chatting with folks on my free dividend Discord while on vacation." So let's start with the basics. Lump sum investing is when you take all of your investable cash, or a large portion of it, and then you invest it all at once. You can see me lump sum investing in a video I did a year and a half ago called "Watch Me Buy $450,000 of Dividend Stocks in My $2 Million Portfolio," where I invested some of my profits I got from selling my house into a bunch of dividend stocks on E-Trade. When we say lump sum investing, I personally think that you need to be talking about amounts of money that are a lot for you, something like a big annual bonus, or a lot of cash you've been saving up, or maybe an inheritance or whatever. But I don't use the term lump sum investing when you take some of your bi-weekly paycheck and invest that all at once. That's more dollar cost averaging, aka DCAing. And there are really two types of DCAing. The first, which is also called systematic investing, is when you consistently invest amounts of cash into your portfolio, like the paycheck example. And the second type of DCAing is if you take a pile of cash that you want to invest and divide it into a bunch of smaller amounts and then invest those smaller chunks over time. So if I had taken my 450 grand of house profit and instead invested 20 grand of it a month for 2 years, then that would be DCAing. The main reason that people lump sum invest is due to the classic saying that time in the markets beats timing the market, i.e. getting your money into the market as soon as possible tends to outperform holding cash for longer periods of time. In fact, a 2021 study by Northwestern Mutual found that lump sum investing outperforms dollar cost averaging almost 75% of the time. That doesn't mean lump sum investing always will outperform, and some of the best investors in the world sit on large piles of cash before they invest, like Mr. Buffett. But when he does invest, he doesn't dollar cost average in, he lump sums. It makes sense that lump sum investing has tended to outperform DCAing when we look at history, because the markets have tended to go up over time, so getting your money into the market sooner means it will be able to go up for longer. But there can be times when you get nailed lump sum investing, like if you invested a bunch right before a massive crash. Now, some people DCA regardless of the asset's price. Some people DCA into their cheapest stocks. Since DCAing is sometimes trying to avoid the risk of a lump sum that's invested right before a crash, many people say that dollar cost averaging is a good way to avoid timing the market. And when I say timing the market, I'm talking about people who try to predict if the whole market is going to crash, and then they sell out with a plan of buying back in once things fall. I'm not talking about people who calculate the value of a business and then buy when it's cheap or sell when it's overpriced. I don't consider that timing the market. Sometimes market timers guess and act correctly, but in my experience the majority of people call it wrong more often than they call it right. These days a lot of experts are predicting that worldwide recessions are coming, which, if true, would also mean that markets would severely crash from here. So they would probably say that lump sum investing right now is probably riskier than if we were in a bull market. It all depends on what you believe and what your investing approach is. I like to lump sum when I come into large amounts of cash, and bottom line I just keep investing whatever investable cash I have, as there's always good deals in the market. It's good to learn how to calculate when something is cheap and then invest when it's on sale, and bottom line the most important thing is to just keep investing over long periods of time in all markets, whether you lump sum or DCA or both or whatever. And accept that there are no guarantees with investing. I mean, just because the US markets have trended up over time doesn't mean they always will. And never invest cash you can't afford to lose. Anyways, DCAing works out if the asset you're investing in goes up in value over time. If your asset doesn't trend up in price, then DCAing doesn't really work. Most people sleep better DCAing, so I'd recommend that to newer investors. But if you can deal with seeing your portfolio drop after a lump sum investment, then over the long run that will probably work out better for you. Whatever strategy you go with, I hope you can refrain from panic buying or selling. A nice thing about DCAing is that it will let you buy the dips automatically as you keep investing. Note, if you're one of the few people that still have brokerage fees when you buy stocks, then a DCA strategy could hurt your gains relative to less frequent lump sum buys. But if you are holding onto cash and are slowly trickling into the markets, then that should be lower risk. But if markets trend up, then obviously you'd have lower returns than if you had just invested it all at once. Conversely, if the market falls, then your DCA will probably do better than if you had lump sum invested at a peak. So if your main concerns are reducing your short-term downside risk, or if it's super important for you to minimize the regret that could come from investing a bunch and having the market crash, then DCAing is probably ideal for you. Thus, what you should do comes down to your own risk tolerance and goals and such. Okay, now let's dig into that Northwest Mutual study. They looked at rolling 10-year returns on $1 million invested starting in 1950 and compared the results between an immediate lump sum investment versus dollar cost averaging. The DCA approach broke the $1 million into equal portions that were invested over 12 months and then held for the remaining 9 years. The study found that a 100% stock portfolio that was lump sum invested outperformed dollar cost averaging 75% of the time. For a portfolio of 60% stocks and 40% bonds, the outperformance rate was 80% in favor of lump sum investing. And a 100% fixed income portfolio outperformed dollar cost averaging 90% of the time. The average outperformance of lump sum investing for the all stock portfolio was about 15%. For a 60-40 portfolio, it was almost 11%, and for the 100% fixed income, it was about 4%. Of course, just because that happened in the past doesn't mean it will happen in the future. Another company that found that lump sum investing generally wins was Vanguard. They said, "Our research indicates that it's prudent to invest a lump sum immediately." And another company, Morningstar, also found that lump sum investing generally beats DCAing. In their paper, Dollar Cost Averaging, Truth and Fiction, Morningstar analysts showed that historically, DCAing has produced lower long-term returns than lump sum investing. At the same time, the returns from DCAing are more uncertain than the results from lump sum investing, and thus when it comes to meeting an investment goal, this could mean greater risk. What Morningstar did was they calculated the results of lump sum investing over all 2, 3, 4, and 120-month periods, and compared them against the final wealth achieved by DCAing into monthly segments over those periods. They then calculated the percentage of cases in which DCA resulted in more wealth than lump sum investing for each time span. What they found was that when you look over the average 10-year time frame, 9 out of 10 times an investor who DCA'd money into the market would have ended up with less money than if they had simply put all their money into the markets in the beginning. An interesting point they made was that when you're dollar cost averaging, you're basically placing a bet that the market will be going down shortly after you invest, and that eventually the market will come back up as you're putting more money into the market. I'd never thought of DCAing in that way before, so I found that point kind of cool. Now, can DCA outform lump sum investing? Yes, it can. But Morningstar found that was only the case about 10% of the time in their study. So you can see that when you DCA'd for 2 months, that only 40% of the time it beats lump sum investing. And as the period of time where you're DCAing gets longer, it wins even less. Like 120-month, aka 10-year DCA, means that less than 10% of the time it will beat lump sum investing. Or let's say you DCA over 20 months, then only about 20% of the time would you have outperformed lump sum investing, at least when looking from 1926 to 2019. Here's a graph from Morningstar looking at data through the crash of 2008 until 2018, comparing lump sum investing versus DCAing. So a $100,000 investment in a 100% stock portfolio grew to about $250K with lump sum investing, versus about $200K with DCAing. And a 60-40 stock bond portfolio lump sum ended around $195K versus about $160K for DCAing it. But what about when we're in a market that kind of meanders along? Well, here's data from the 1970s that showed that a 60-40 stock bond portfolio that was lump sum starting at $100K ended on top at around $190K after 10 years. Behind it was the 100% stocks portfolio that was lump summed and which ended around $175K. And then you could see that both of those portfolios, if dollar cost averaged, ended at around $140K. And then how do things go in a bear market? Well, a nasty time was from 2000 to 2010, since we had both the dot-com crash and the 2008 crash. I gotta tell you, that was a tough time to be investing. Okay, now we see that the lump sum 60-40 portfolio ended at $125K on top, with the 60-40 DCA just behind it at $120K-ish. And below that, the DCA of the 100% stock portfolio ended at $105K, and then the lump sum 100% stock portfolio did the worst, ending at $90K. So from all that, it seems reasonable to conclude that lump sum investing tends to win out over the long run, and a portfolio of 100% stocks also tends to win out over the long run, assuming the stocks you hold trend like the markets have trended historically. Morningstar concluded that the fundamental problem with DCAing is that it actually is a market timing strategy, since you are sitting on some cash and are trickling it in, rather than investing at all. I still think it's fine to DCA that way, because you are just investing in a more conservative manner, and as long as you accept the trade-offs of what normally happens, then all's good. Okay, here's another study that found that lump sum investing tends to outperform. It's from Wells Fargo and DST Retirement Solutions. They compared the performance of a $12,000 lump sum investment in stocks to the performance of a $12,000 portfolio that was DCA'd. As you can see, lump sum investing won out, but it was during a bull market decade. I also found some analysis from people outside the financial industry that also concluded that lump sum investing tends to win. It was from a couple of university professors that concluded that. They tracked lump sum versus systematic investments over 780 different 12-month periods from 1926 through 1991, and they found that an investor would have fared better about 65% of the time they lump summed. But hey, you never know what the future might bring, and what you often do depends on your situation and risk tolerances. Like if you're 70 years old and you just got $1 million inheritance, could you handle investing it all at once and then seeing the market crash? I could, but I'm not you. If I hadn't been investing for decades and didn't already have a decently sized portfolio, then I'd probably just DCA the million I inherited, and I would be okay if my gains were less than if I lump summed, because I could sleep easier at night. Another useful finding to be aware of from the Northwest Mutual study was that they concluded that DCAing is a better strategy than saving up cash and waiting to invest it all at once. They also said that we consistently see cash as being one of the lowest returning asset classes over the long term, so they said not to maintain high cash balances. Regardless, if you do inherit a lump sum of money and you aren't an experienced investor, then I'd recommend you might want to talk to a financial advisor before going it alone. Okay, back to Nort's initial question. If it were me, then I'd lump sum invest, but that might not be right for you. Now, in terms of the stocks you mentioned, well, J&J doesn't look cheap to me right now, just reasonably priced. I feel Procter & Gamble is still a bit expensive, and AbbVie, which is probably the riskiest of the group, seems the cheapest. Again, I can't tell you what to do, but those are my thoughts on it. And if you made it this far in the video, then please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Okay, now I'd like to shout out my newest Patreon aristocrat who signed up since my last video. So thank you, William Hutchinson, for signing up. Aristocrats gain access to my dividend spreadsheet product that I use in many of my videos, and they gain access to multiple private channels on my free dividend Discord chat server, where I let my upper tier Patreons watch my videos before I release them to the public, as well as I let them vote on which thumbnails I use for my videos, and of course they get more direct access to me. Finally, I highly recommend that you join my free dividend Discord chat server, which has thousands of investors on it from around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.